Welcome to The Winning Trade. Each episode in this series will demonstrate how to make money in the stock market, whether the prices are going up, down, or sideways, using high probability, profitable strategies that were designed to take advantage of the volatility of the Russell 2000 and the S&P 500 indexes. Many of these strategies were designed to work together to maximize profits by flowing with the ever-changing market conditions. Follow along as we uncover the secrets of this episode's Winning Trade. Hello everyone, my name is John Locke and I'd like to welcome you to The Winning Trade. But first, the required disclaimer material. This presentation is given for educational purposes only. We are not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial, so make sure you are aware of all your risks prior to placing any trades. And also note that we're using hypothetical computer-simulated trades and results, and they are believed to be as accurately represented as possible, but keep in mind that live results can vary from simulated results for many, many different reasons. Let's move on. If this is your first experience with us, my name is John Locke. I'm a trading performance and success coach with Lock in Your Success LLC, and myself and my team are here to help you win in the market and in life as well. I'm here today to guide you into the realm of high probability income trading. Now in a moment, not now but in a moment, we're going to go over the winning trade, but before we do, let me quickly explain what we mean by an income or high probability trading strategy. An income strategy is where we put ourselves in a position to generate profits through the passage of time rather than depending solely on price movement to go in the right direction, meaning we can often make money whether the price goes up, down, or sideways. Now this doesn't mean we're going to win all the time, but it does mean the probabilities are much more in favor of us winning than they otherwise would be. Now, when you find that you want more information as you're following along, simply contact us at lockinyoursuccess.com or ask a question in the comments on this video, and we can direct you to where you can find more information. Let's move on. The winning trade we're looking at today is called a bearish butterfly. The bearish butterfly is one of three primary trading structures we utilize in the rock trading system, and the bearish butterfly is designed to maximize results in very choppy and bearish market conditions. It requires a minimum of $5,000 per trade to trade. The example size we're doing today is going to be $50,000 planned capital. It's going to have a high profit target of 30%. Or $15,000 with our trade size, and a reduced profit target late in the trade when we get 21 days to expiration of 10% or $5,000 in this case. Our exit loss trigger is 30% or $15,000. When we look at this trade is entered as a butterfly with the short strikes 20 points under the money. Now, butterfly is just two vertical spreads facing in opposite directions. So we have 10 long strikes at 16.10, we have 10 short strikes at 15.60 for that spread. Then we sell another 10 15.60s for the other spread, and then we buy 10 15.10s. So we have a bearish vertical spread and a bullish vertical spread. And that gives us a butterfly, and in this case we have 50-point wings, meaning we have a difference of 5 strikes between our short strikes and our long strikes. If we look at the position here, the triangle-shaped line is what we call the expiration graph, or the value of this position at any given price point at expiration. So our asset price goes along the bottom here. It's currently a little bit over 1580. And if the position were to expire today, then the value of the position would be way up here, a little bit over $18,000. But that is not the case today. That's the case in the future. As of today, we have this dashed line, and this is called the T plus 0 line, or the time plus 0, or the today line. And this gives us an estimated value of the position at any given price point along this line. Now, with this strategy, what happens is if the market comes down to 10 points over the long strike, in this case it's going to be 15.20, then what we do is we roll the position back to at the money. If the price goes up, then we have a series of price point where we adjust the strategy and add to the strategy. So we start with our shorts at 1560, and if the position gets to 1600, we're going to add in some butterflies at 1580. If the position gets to 1620, we're going to add some butterflies in at 1600. And then if the market continues to go up, we enter this rolling sequence to stay up with the marketplace. So that's essentially what happens in a nutshell with this position. So let's take a look at what happens here. If we skip forward to August 2nd, the asset prices come down quite a bit. If we take a look at our price charts, we entered the position back here when the market was at 1580, and we had a little bit of sideways chop, and then we had a relatively large down move, and now we're just broken down underneath our primary support level here, and the market's coming down. Now, typically, when this position gets back to here in the position, usually this is up more money. If you took a look at this at entry, you would have noticed the T+0 line was sitting a little bit higher. And that's why this T+0 line is only a projection of what the market should be at a certain price level, because we have something called implied volatility. And implied volatility really shifts the value of our position around quite a bit. And in this case, the implied volatility went up more than what would be expected for this type of a move, and that being the case, we got a T+0 line crush. But despite that, we're still up some money. Position looks great. We have an adjustment point at 1520. If we go to the following day, we get a very large down move in the marketplace, 42 points down. That's a monster move for the Russell, and that happened to put us way, way past our adjustment point. Now, in this strategy and most of the strategies that we do here, we're not generally watching the market in the middle of the day, and we don't really care how much we get past our adjustment points in the middle of the day. We just wait till the end of the day and see where the market is. We make our decisions from there. So in this case here, we had an adjustment point of 1520, and the market's all the way down to 1490. Now, we did get drawn down a bit here, but it's certainly nothing catastrophic, and we are due for an adjustment. So what we would do here is we would remove this butterfly, and we go back to at the money. And then once we go back to at the money, we reset all our price points again. So here, our previous position was up here. Sell that, and our adjusted position is down here. And this is what the new position looks like. And it's the same strategy from here. If we get back into 1410, we roll this back. We have our short strikes at 1490, so we're going to add at 1530, 1550, and then we're going to start rolling after that if we get continued up moves. So here's our position here, and we're going to move forward 3 days to August 8th. And what happened here is the market took off in the other direction. So if we take a look at our price charts, we had our very large drop here into our more primary support level, and now we're getting the bounce to the upside. So what happened is we set a new reference point at 1490. We had an add point of 1530. We're currently at 1532. So, and it's the end of the day checkpoint time. So we're going to come in here. We're going to add in this position, and now we're down about $2,000, and we look something like this. One of the things I'd like you to notice, and one of the things I love about this strategy, it's a $50,000 planned capital position, but I only have $16,000 in the position. So, and I have a $15,000 maximum loss, and I only have $16,000 in the position. And that makes it very unlikely we're going to hit any kind of maximum loss number here. So, from here, we got our up move. It's going to scoot ahead a few days. And the market starts coming down. You see how quickly this recovers. Right, here's our position 2 days later. At this point, I do have an adjustment at this number right here. See the purple dotted line where the expiration graph crosses zero. We have an adjustment there to remove the upper butterfly if we get that far down. I don't think that ever happens in this strategy. I'm going to move forward a few more days. All right, looking good. We're up $5,800, and we got this pullback in the market. We're not to our adjustment point yet, which is back at this purple line here. So everything looks good. Let's move it a few more days ahead. We're now 31 days to expiration. We have a $15,000 profit target. We're up only $6,600, so we just keep rolling here. If we move ahead another week, we get another relatively large down move in the Russell. But even despite the down move, despite the volatility increases we're getting, our position is still up $7,700. And if we take a look at the price charts, we're getting some pretty wide chop here right now in the Russell. And again, 44 is much, much larger than normal move historically for the Russell. But everything looks good here. If we take a look at our analyzed graph, we are slightly outside our tent, but we have not yet exceeded our adjustment point. So let's move this forward a few more days. We are still getting close to an adjustment point, but haven't not yet exceeded it, and everything is looking fine within the position. It's now up $9,500. Go to Wednesday, we get a decent bounce. We're up $11,000. Thursday, we get a really big move. It draws us down a little bit off of our peak value, but the position right here is looking very fine. And if we go to Friday, we have a relatively flat day. Now, we're only up $10,000. Our initial profit target was $15,000. But remember that we had two profit targets. We had a high profit target and a low profit target. When the position hits 21 days to expiration, we go from our $15,000 profit target down to our $5,000 profit target. And since we're up over $10,000 at this point, we would exit the position. So we close this out for a profit of about $10,000, which happens to be a little over 20% of our planned capital of $50,000, but it's more than 60% of our actual capital in the trade of $16,000. So that was a fantastic trade for our September expiration. And that was the Bearish Butterfly strategy, this episode's winning trade. If you like what you see, I encourage you to join us, where you too can discover how you can follow along with this and other great strategies as they unfold during our weekly Options Trading for Income webinars, and where you can also learn about upcoming winning trade presentations. And perhaps best of all, you can get informed about our free Trading Performance podcast, where you can learn to become a much, much more effective trader regardless of the type of trading you do. If you have any questions or comments or anything you'd like to see on the next winning trade, we'd love to hear from you. Simply comment on this video below so we can get those answered for you. And we would also encourage you to come on over to thewinningtrade.com, that's thewinningtrade.com, where you can find past episodes of The Winning Trade, as well as a lot of other fantastic information on how to profit through income trading. Thank you, and we'll see you on the next winning trade.